Joining us now is Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Larry, always a pleasure to have you on board with us. Thank you so much for joining us. Now, just let's talk a bit more about the oil price, because it does seem like the oil price today has overshadowed some of those lingering concerns about trade tensions. There are reports that US is pushing its allies to halt imports of Iranian crude at a time as well we're expecting some supply disruptions in Canada. What's your view on where oil heads now that the OPEC meeting is out the way?
Well, I still am bearish on the oil price, and I had my day in the sun very briefly last week. And obviously, it continues to drive higher on headline risk, not on actuality. The latest EIA report came out, slightly bullish for crude, but very, actually a little bit bearish on products. I still maintain that we'll see an oil price in the low 60s. That was my target price from the very beginning of the year. Fully acknowledging geopolitical risk is really front and center, and it probably should be. I think, with China is the #1 importer of crude from the U.S., even though I think a lot of these headlines are nothing but headlines, it's something that you probably don't want to get in the way of, and that's why we're seeing such volatile markets, especially in crude.
So if you're bearish on the outlook for the oil price, does that also mean that you're bearish on the outlook for the rest of the commodities complex and base metals or gold, given the fact that we are seeing these escalating trade tensions? And if they continue to escalate further, they may in fact continue to weigh on those commodity prices.
Yeah, well, it's a little bit different, I think. Like with gold, down about $7 today, I believe, and it's getting closer to my target price where I'd want to start buying it. In the U.S. Denomination, about $12.50 an ounce, and I think we're getting close to that. It's been really interesting to watch gold just do nothing through all of this, and it just has a real identity crisis of what it actually is. And so around $12.50, I definitely would start buying. When it comes to metals outside of that, sadly, I'm going to be reducing my outlook with iron ore. I've been a lot more bullish than consensus all year, but it is more moderating at this point. And I think there's only definitely a good case for some of the other metals, but not a really, really strong case, just given the downstroke in economic data that we have seen coming from China.
Let's talk outside of commodities and the broader market. It is all about trade tensions at this point, still front and centre for a lot of investors. And even though the market has been, somewhat calm up until this point, we really kicked off the new week yesterday well into the red. You get the feeling that investors are becoming more concerned now about these trade tensions and perhaps is becoming a larger problem. What is your view on how the market is tracking right now, how it's coping with these escalating tensions?
Yeah, great question. And, as much as the trade headlines are headlines and the secondary risks could be very big, we saw that Friday with PMIs really came out pretty badly in the U.S. Business confidence numbers starting to dwindle. All that to say, though, I don't think that's the immediate risk. I think the bigger risk is really technology and that enormous divide between growth and tech. If you took 5 to 6 stocks out of the S&P 500, the S&P 500 would be down 4 to 5% on the year. So, there's been a big chasm between growth and value. And if there continues to be, there wasn't today, but if we see a repeat of yesterday when people start unwinding the super cap tech names, it's going to spell trouble for the market, along with the fact that, you have the Bank of Japan, ECB, FOMC all tiptoeing towards normalization one way or the other. It just makes financial conditions tighter, and it just raises the bar on what needs to happen for a stock market to rally.